When people think of Apple, they think of the iPhone. And if you look at the company's financial statements, it's easy to see why. The iPhone makes up about half of the company's revenue, or perhaps more than $200 billion this year. 50% is already a lot of weight on one product. But if we look further, we can see that Apple's reliance on the iPhone goes even deeper. That has analysts wondering whether Apple is almost entirely dependent on the iPhone for its business, when you count the indirect impacts. And if that's the case, it could mean extra risk for investors to consider. Let's take a look at Apple's earnings forecast. Analyst Laura Martin from Needham estimates that Apple's revenue this fiscal year could amount to $420 billion, and iPhone revenue could account for half of that, or about $215 billion. Meanwhile, Apple could get about $108 billion from services, which are things like the App Store, iCloud, and Apple Music. Services is actually Apple's second largest revenue segment besides the iPhone. But Martin thinks the category is essentially 100% dependent on the iPhone and iPhone ownership. After all, Android users probably aren't paying for Apple Music when there are other options on the market. To illustrate this dependency, let's add some stripes over the services segment of the pie. Now let's look at Apple's other hardware categories like iPads, Macs, and wearables. Together, these represent about $97 billion of projected revenue for fiscal 2025. You might be thinking, these are standalone products, so how can they be dependent on the iPhone? But Needham estimates that 50 to 80% of customers would churn out, meaning leave the ecosystem, if they stopped owning iPhones. This all means that even by Needham's most conservative estimate, 89% of Apple's revenue either indirectly or directly depends on a single product, the iPhone. This starkly contrasts with other big companies like Google, Amazon, and Microsoft, which are far more diversified. Think about Amazon. The company's retail and cloud businesses are not really dependent on one another. The same is true for Microsoft, which does big business selling software like Office, and that's totally different from the work in the cloud. This dependence on the iPhone explains why the stakes are so high for the latest iPhone 16 launch, which may not have gotten off to the strongest start. One prominent Apple analyst estimated that sales dropped 12.7% in the critical first weekend compared to what was seen for the iPhone 15 a year before. It's possible that customers may be waiting to buy until the Apple Intelligence AI software becomes fully available on the iPhone 16 in the coming months. But Apple's flywheel depends on the company getting new iPhone customers who will then spend up on all those other product categories. If the iPhone 16 proves disappointing beyond the first initial rush of sales, that could have broader implications across the business. Another risk is that Asian smartphone manufacturers have been more innovative than Apple recently. For example, Samsung has had a foldable phone available in the market since 2019. Sometimes reports say that Apple has a foldable iPhone in the works, but we've yet to see one. Since Apple's growth is so dependent on emerging markets, it's notable that the company is so behind the curve on this design trend. The Needham analysts still like Apple, since the company isn't spending boatloads of money on AI like some of its competitors, and stock buybacks help earnings per share. But they think investors should still pay attention to the stock's multiple, and ask whether it appropriately reflects that the company is so dependent on one product, especially relative to tech peers that are far more diversified.